Ever wondered how you can reduce your tax liability legally? Well, it's quite possible, and all thanks to Section 80 of the Income Tax Act of 1961. This section, my friends, is a boon for taxpayers. It offers a legal pathway to reduce your tax liability by providing certain deductions. So, what exactly is Section 80? In essence, it's a collection of laws that provide tax deductions on specific expenses and investments. The objective of these deductions is to encourage taxpayers to save and invest while also providing financial relief on certain expenses. It's like a win-win situation for you and your finances. And the best part? There are numerous deductions available under this section, catering to a wide range of expenses and investments. So, there's a good chance you'll find something that suits your financial situation perfectly. Now that you know what Section 80 is about, let's dive into the different deductions it allows. First up, we have Section 80C. This section is a jewel in the crown of the Income Tax Act, as it allows deductions up to 1.5 lakh rupees from your total income. Now, this means that if you invest in certain specified instruments or make certain specified expenditures, you can reduce your total taxable income and consequently your tax liability. So, what are these specified instruments and expenditures? Well, the list is quite extensive. To start off, investments in life insurance premiums, employee provident fund, public provident fund, and 5-year fixed deposits with banks and post offices all qualify for deductions under Section 80C. Moreover, if you have a penchant for the stock market, then equity-linked savings schemes, also known as ELSS, are your go-to option. But that's not all. Expenses such as tuition fees for your children and the principal repayment of your housing loan also fall under the umbrella of Section 80C. And if you're a fan of long-term commitments, then the National Savings Certificate and the Senior Citizen Savings Scheme might just be the cherry on top for you. Now, while this all sounds fantastic, it's essential to remember that the maximum limit for deduction under Section 80C is 1.5 lakh rupees. This means that even if your total investments and expenses in the specified avenues exceed this amount, the deduction you can claim will still be capped at 1.5 lakh rupees. To sum it all up, Section 80C is a powerful tool in your tax planning arsenal. It encourages savings, helps you manage your expenses, and most importantly, allows you to reduce your tax liability. So, go ahead, explore these avenues and find what works best for you. So, that's Section 80C for you, a great way to save on taxes if you're investing in specified avenues. Next, let's talk about Section 80D. This section of the Income Tax Act of 1961 is a lifesaver for many, providing relief by allowing deductions on medical insurance premiums. It's not just about insurance though. Section 80D also extends to preventive health checkups. So, those annual doctor visits, yes, they count towards your deduction too. Now, let's talk numbers. For individuals below 60, the maximum deduction limit is 25,000 rupees. If you're a senior citizen, this limit increases to 50,000 rupees. But what about Hindu undivided families or HUFs? Well, they too can claim a deduction under this section with a limit of 25,000 rupees. Remember, these amounts are not set in stone and are subject to changes as per the tax laws. So, always keep an eye on the updates. That's how Section 80D helps you offset your medical expenses against your taxable income. Moving on, we have Section 80E. Now, imagine you're pursuing higher education and you've taken an education loan to support your dreams. Section 80E of the Income Tax Act is your best friend in this journey. Why, you ask? Well, it allows you to claim a deduction on the interest paid on that education loan. And the best part, there's no upper limit on the amount of deduction. This deduction is applicable not just for you, but also if the loan is taken for your spouse or your children. It extends to even loans for vocational courses after high school, making it quite versatile. The deduction is available for 8 years, starting from the year you begin repaying the loan or until the interest is completely paid off. whichever comes first. So if you've taken an education loan, don't forget to claim this deduction. That's Section 80E, a boon for those seeking higher education loans. But that's not all. There are more sections under Section 80. Now let's delve into some other deductions that can be claimed under this umbrella. For instance, there's Section 80G. This section is all about donations. If you've made donations to certain funds or charitable institutions, you may be eligible for deductions. The amount of the deduction can range from 50 to 100% of the donation, depending on the organization you're donating to. Next, we have Section 80 TTA. This one is for those of you who earn interest from your savings account. If your interest earnings don't exceed 10,000 rupees in a financial year, you can claim them as a deduction under this section. Then there's Section 80U, which is specifically for individuals with disabilities. If you or a dependent have a disability, you could be eligible for deductions under this section. The amount of the deduction depends on the severity of the disability, with a higher deduction for severe disabilities. Let's move on to Section 80GG, which pertains to rent paid. If you're paying rent and don't receive a house rent allowance, you might be able to claim a deduction under this section. The deduction is the least of three amounts: 5,000 rupees per month, 25% of your total income, or the rent paid minus 10% of your total income. Finally, we come to Section 80 RRB, which is about royalties on patents. If you're earning income in the form of royalties from a patent registered under your name, you can claim a deduction of up to 3 lakh rupees. So there are many ways you can reduce your tax liability under Section 80. Each one of these deductions has its own set of conditions and limitations, so it's essential to understand them well to make the most of your tax planning. Remember, every rupee saved is a rupee earned. Let's recap what we've discussed today. We've delved into the depths of Section 80 of the Income Tax Act, 1961, a critical piece of legislation that offers several avenues for tax savings. We started with Section 80C, one of the most popular sections, offering deductions on investments and expenses, up to a limit of 1.5 lakh rupees annually. Moving on, we explored Section 80D, which provides deductions on health insurance premiums, a vital provision in today's health-conscious world. We then tackled Section 80E, offering deductions on interest paid on education loans, supporting the pursuit of higher education. Finally, we touched upon the myriad other deductions available under this section, further underlining the vast opportunities for tax optimization. The crucial takeaway here is the importance of understanding these deductions to maximize your tax savings. Remember, the more you know about these deductions, the more you can save on your taxes. Until next time, stay informed and keep saving.